Hey, my name's James Nicholson and welcome to my YouTube channel. In this video, I've got a major lender that's cut rates to match other big lenders' rates. Now, this could be good. Maybe you're already with this lender and it will make it easier to switch over, less credit checks and all that kind of stuff. And it's also good to just see more competition in the mortgage market. We've seen the mortgage market heating up now for about 2 months. And that came off the back that the market slowed significantly in this summer. So last December, the market was slow. And what the mortgage lenders did was to cut rates between themselves, starting a pricing war, which got the market moving again. Then by spring, it was doing okay. And at that point, the rates started to creep back up. The mortgage rate that you and I get started to creep back up. And so that slowed the market significantly. And the market is slower. It's picking up, but it is slow. And it has been quite a slow summer this year. So mortgage lenders, with the fact that inflation was down, with the fact that the Bank of England cut, the Federal Reserve cut, and it's quiet, have been cutting rates. So before we jump into who this lender is, I'm going to ask you something very quickly. If you haven't done, do subscribe to the channel over there and hit the bell notification. We're on the way to 31,000 subscribers now. And let's get some more views on the channel by smashing like, tickling like, doing something to that like button. That really helps me with the YouTube algorithm. And I appreciate everybody that does that. So we're talking about an HSBC brand, and that's called First Direct, which is interesting because what happens is over the last few months, we've seen the normal people fighting over being cheapest in the market. We see Nationwide, we see the Mortgage Works, which is their buy-to-let division. We've seen Barclays, but we haven't seen First Direct really being competitive. So this is good to see someone new in the market, and the more people competing, the better for all of us. Now, it's interesting. This could be back off the news that the Bank of England, they're always doing talks and press conferences and business speeches and stuff like that. And they've said that potentially they could look at cutting rates more aggressively. That's interesting, and we want to hear that. And that probably means that they're expecting unemployment to go up and us to get close, or the fact that we may be going into a recession. That is the sort of data they're looking at. Now, inflation is important, and that's their primary goal, but inflation is going to start dropping again early next year anyway. And so they want to start looking at employment now. That's the next barometer that they're looking at. So let's look at these HSBC rates and how they stack up. You've got a 2-year deal here with the loan to value on this one is 85%. So that means you need a 15% deposit or 15% equity. This is a good deal for first time buyers and maybe people that haven't got lots of equity in the property. In this scenario, they will give you 4.09%, and the fees are, put the fees below, running out of space, 490, which is definitely better, because I know when I put rates up, a lot of you say, well, the fees are crazy. That's not bad. That's definitely moving in the right direction. I wouldn't let a £500 fee put me off a lender if I liked the lender and the rate was good. So decent there. Let's have a look at the other deals that they've got, because they've got some more. They have here a 3-year deal. Again, 85% loan to value. And on this deal, the rate is 4.79%, and the fees are 490 as well. So in this one, they made a massive deal in the press release talking about pretty much all of their deals now are under 5%. That's important for a lot of people, because We had the mini budget where we were at rates at 6.5%, 7% for some people, and that's not really affordable. So the fact is that nearly all of their rates are below 5% is really, really positive. And obviously they're going to get better as time goes on, particularly if the Bank of England do cut rates aggressively, like they've just said, potentially they're going to do. So we're going to do some more research into that, and I'll make a video update on that very soon. Another reason to subscribe. So what else have we got here? This is their best deal. This is their headline rate, which is the 5-year deal here. And this one, I don't know why, but it's only for 60% loan to value. So you've got to have 40% equity. They're really playing it safe with this one. But this is the best deal. I guess 40% equity, that really is a safe bet for them. It's unlikely that the market's going to drop at that kind of rate. So you've got 60% loan to value, and the rate on this one is 3.79%, which is decent, and the fees are $4.90. So First Direct, it is really positive to see a different lender for once actually standing out, and that's good, because what that means is we'll probably see Barclays counter this over the next few weeks. They've done that quite often, and Nationwide keep beating most people, so it'll be interesting to keep an eye on, even if it's a smidge and they just keep fighting over this and bringing this rate down a little bit at a time. I think that's really, really positive. Remember, we're in October. I don't think we've got any meetings with central banks this month. Most of them are after the American election, but they both look quite positive. The two that we've got to really worry about, we've got the Federal Reserve. They cut 0.5%. Potentially they will cut 0.5% again. If they do, that gives them, between us and them, 0.75% difference. So that means the Bank of England has space to cut 0.5%, and they've still got higher interest rates than the Federal Reserve. And we like to, what we say, follow the Fed. So if the Americans cut 0.5%, that's a good sign for British interest rates. So we want to keep a massive eye on that. And we want to listen to what they're talking about at the moment. There's a lot going on that could put a spanner in the works. You've got a dock strike in America. So the East Coast docks are all shut down. The longshoremen there that make 150 grand a year want a 77% pay rise. And here's the interesting thing. They got offered 50% and said no. So that port is closed. That could potentially play with inflation. We've got to keep an eye on that. I don't know if it will hit us. I don't know what will come out through there. I guess it could cause some problems. So we want to keep an eye on that. And obviously the Israel-Iran stuff, the oil will go up. How long? Who knows? Oil consumption is down massively at the moment, which has been driving oil prices down. So look, lots going on. First Direct, go and check them out if that's someone that you want to look at, or look at Barclays. They've got some good deals as well. I'll keep you abreast of all the deals as and when I see the press releases coming out. So do subscribe for that. Do hit that like button and check out all the other content on my channel, including this video right here.